What does it all mean when we're seeing governors across the emerging and developed market space starting to consider inflation?
Inflation is definitely the buzzword for 2011. You know, I think if the buzzword for 2010 was all about growth and this dichotomy between a double dip versus real growth, 2011 is all going to be about inflation. I think there are two key concerns. I think the first key concern is about underlying food prices, and we've seen a dramatic increase in food prices globally in the course of the last 6 to 12 months. And the other concern, obviously, is the events in the Middle East and what effect that has on energy prices.
Okay, what we have started to see, however, is that inflation is ticking up in a country like Britain. February came in at 4.4%, and although there hasn't been a major decision to hike rates in the Bank of England, the MPC is not unanimous in its perspective on what to do. So if we're starting to see traditional developed economies consider moving or changing the rate cycle, what sort of bearing is that going to have on the rest of the world?
Look, I think we need to actually categorize the developed countries. There's some developed countries where the emphasis on incipient inflation is particularly high, and I think that there's a particular focus on making sure that they're ahead of the curve. So we're expecting the ECB, for instance, to tighten by about 50 basis points, an initial 25 basis points in the second quarter and 25 basis points in the third quarter. We expect the BOE to actually come out and do about 75 basis points this year. We do not expect the U.S. Federal Reserve to tighten rates anytime this particular year, and I think the key difference there is that there's still an emphasis on growth. There's still excess slack capacity in the U.S. system. When you look at capacity utilization numbers, when you look at unemployment numbers, it still indicates that there's still fairly good capacity in the U.S. to grow a bit further.
Okay, within the emerging markets, I mean, they're growing all above 7%, particularly the BRIC economies. But there we've also seen a significant tick up in inflation, and it's got the Chinese worried, it's got the Indians worried. In countries like Russia, for instance, inflation is above 8%. Is it worrying for them, given that their growth rates are also phenomenally high?
Yeah, it is. And again, Lerato, this is where, again, categorize the developing world as well. I think if you look at economies like China, like India, and go back to this concept of excess capacity, they clearly are running at fairly close to full capacity levels. Capacity utilization, employment numbers have actually gone up fairly significantly over the last couple of years. When you look at African economies, there is an incipient inflation problem with the African economies. If you look at some of the January data that came out from Kenya, that came out from Uganda, Seychelles, Mauritius, inflation is a problem, but the key difference for us, Lerato, is the fact that there's still plenty of capacity for growth within our economies.
Okay, this raises then the issue about what the African central bank governors ought to do. We've seen a rate hike in Nigeria this week, 100 basis points. We've seen 25 basis points in Kenya, and we're seeing hawkish sentiment but cautious action on the part of the South African Reserve Bank.
Yeah, I think you will continue to see certain economies in Africa be probably a bit more aggressive on the policy front. So certainly the case in Nigeria. You know, Kenya, a bit of a surprise, but we did see Kenya raising rates as well. There have been raising of rates in places like Mozambique. But for the most part, if you look across sub-Saharan Africa, policy rates are still fairly accommodative. They're coming off of a fairly low base as well. And also keep in mind that fiscal policy is still very accommodative at this point in time.
Okay, then, you know, I think in terms of wisdom and what's prudent for many of these central banks to take by way of action, a lot have also assumed growth mandates over and above the need to curb inflation, which is a reality across net importers in Africa. But can we manage inflation and at the same time grow these economies? Because most African countries have to start growing above 6%. No,
that's absolutely right, Lerato. And you know, let's not be mistaken here. I mean, this rise in agricultural prices, and if we continue to see a consistent rise in energy prices, this is going to be a problem. And this is going to be a problem that monetary policy officials across sub-Saharan Africa are going to have to confront. It does not seem to be a problem as yet, just given where we are, although we have started to see some of these worrying figures. And again, you still have some accommodation on the fiscal side that does help.
What about African currencies? Because obviously due to the MENA crisis and the rise in oil prices, we've seen some volatility regarding the dollar. But last week we saw 17-year lows for the shilling. We've seen some fluctuations for the rand, and we've also seen some depreciation of the naira.
I think we will continue to see volatility across sub-Saharan African currencies. You know, for example, you mentioned the naira. There's obviously a presidential election happening in Nigeria next month. That's going to have some bearing on that as well. But the key feature this year is really going to be about dollar weakness. With the U.S. still very accommodative and with questions just around the sustainability of some of the quantitative easing measures that the U.S. Federal Reserve has put into place as well, this is going to be a dollar weakness story for the course of 2011.
But you know, this is the irony. Dollar weakness, for instance, and you know, the elections notwithstanding in Nigeria, dollar weakness has not meant Naira's strength. It has not necessarily meant phenomenal shilling strength. So where does that put African currencies, and what should some of these central banks be doing about the situation?
You know, you bring up a very good point, Lerato. I mean, I think if I step back and I look at the last 2-3 years from an investor perspective, it was really all about undervalued assets. So if you looked at the developed world, if you looked at emerging markets, it literally was one of those cases, one of those rare instances in time where you literally could put a dollar into a lot of these economies and do fairly well. I think that has changed. I think that what investors should be focused on now is specific systematic risk within specific countries. So what I mean by that is if there are specific situations happening in places like Nigeria or Kenya, whatever the case may be, this is not a case of just macroly putting dollars into an investment portfolio and expecting it to perform, as was the case in the past
And very briefly, we've got to go, you know, if interest rates are not the only instrument available to central banks or the most effective instrument, what else can they do?
There are a number of things. So it's interesting, for example, if you look at the Chinese economy, the Chinese authorities have tightened up on property lending and on credit standards. There are things that the central authorities can do around reserve requirements in commercial banks. One actually very interesting measure that the Chinese government has also instituted to control food inflation is to actually offer subsidies on food, and in some instances actually offer almost close to free food to the population as well. So there are various instruments that that monetary and government officials can use. I think the key tenets, though, are going to be monetary policy and fiscal policy.